let's take a look at another example. So let's say originally for revenue T accounts, you have the credit balance $6,000, and now you want to close this account, then this will be the journal entry to make. So original balance $6,000 is on the right side. You want to close the entry by debiting the amount. And debit service revenue, credit to income summary. So we're just copy and pasting, transferring revenue to income summary. Okay, second journal entry, here is an example where there's two different expense accounts. So normally for businesses, it's very likely that you'll have multiple expense accounts. You can have utilities, salary, advertising, rent expense, interest expense. All sorts of expense accounts will be closed together in one entry. Okay, so here's an example. If you have 4 of them, then you will see the credit side listing 4 accounts. Okay, this week you also have a homework on one of the problems on closing entries. You'll have multiple expense accounts, just list them one by one. And then add the total expense amount, then you debit it to income summary. Okay, so this is an example. There's $1,500 expense for one account, $500 for utility. Add them together, $2,000. You want to transfer that to income summary account by debiting it. Okay, so by doing this step, this expense account, multiple ones, all of them closes out, zeroes out to having a new balance, 0. So what is the company's net income now? By doing these 2 entries, can you tell me what is the net income? 4,000, and how will we be transferring that to retained earnings? Want to try? As a credit to retained earnings, and then the other side will be debiting income summary. Exactly. Okay, so you have revenue $6,000 there in income summary. Then expenses altogether $2,000. So net income is $4,000. You know this. And if you're confused with income summary side, just think about retained earnings. Okay, $4,000 of net income definitely increases retained earnings. So you'll be crediting retained earnings for sure, and the other side will be income summary. Okay, if income summary, if you find it very confusing, just think about the other side. If we want to close revenue, you know the balance, normal balance is credit, so if you want to close it, you definitely have to debit it. So once you know revenue, you have to debit it, the other side, you'll be crediting income summary. For expenses, by now you should know the normal balance is debit. So if you want to zero out, you have to credit expense. If you credit expense, then you will be debiting income summary. When it reaches the third entry, the only question you have to ask yourself is whether the company has net income or not. If there is net income, that brings up retained earnings balance, so you know you will have to credit retained earnings to capture this balance. Okay, the other side will be income summary. Now for dividends, definitely this reduces retained earnings, so you'll be debiting retained earnings. And dividends, if you want to close it out, you know for a fact the normal balance is debit, so you definitely have to credit dividends. And this reduces retained earnings by $800. Okay, so meaning for the $4,000 of net income, really what's kept later on in the business is $3,200 only, because $800 you gave that away. Okay, so the net effect, what really increases, what really goes into retained earnings, overall, $800 cancels out. There's only $3,200 accumulated in retained earnings account. All right, if we look at all the T accounts together, really this is the same thing as I showed.